Alright, what's up guys? I hope you're doing well. James here from jamesdforsyth.com, and continuing on with A Primier on Money by John William Wright Patman. Talked a little bit about this in the previous video, but now we're actually going to go through and, go about it. One of the things that he argues a lot, and this was written in the mid-1960s, and so basically when the Federal Reserve had much higher interest rates, especially relative to now. So he really argues against high interest rate policy, mostly from the perspective, at least his argument seems to be, that it's mostly for bankers to basically have windfall profits, like all the time, no matter what. And so he says specifically an increase in interest rates means that there's an increase in business costs, and so not only just from a kind of a governance perspective, but also from, he's like kind of a quote-unquote free market perspective from his point of view, on how higher interest rates basically make it worse on businesses, right? Mostly for borrowing money, right? And so, which seems to be kind of a general consensus view, because it seems logical, right? If you want to borrow money at a higher interest rate, if you're paying more interest, that's a burden on the business, which, yeah. So, there's that. And also, so the cost of the goods consumers buy has an element of interest cost fitted in, which must be included in prices for profitable operation, right? So, again, business costs are going to basically be pushed off onto the consumer, right? Especially beyond a certain point, because a business can only take so much, and if they're not going to profit, they're not going to stay open. From an entrepreneurial perspective, you need to have that kind of incentive. You have to have a reason to do this, right? And so you have to be able to make money off of it. That's kind of the point. So, the rate of business investment, in turn, is a major determinant of economic activity, which makes sense. GDP growth and everything else, you need to have business production. That's the whole point. That's what value is, and the whole point of money. Goes back on the whole idea, wealth is not money. It's the goods and services you can buy with it. That's what really matters at the end of the day, and that's something I've said quite a few times. But let's see, to continue on, I should say. One of the important ways an economy grows is by becoming more efficient. That is by creating and adopting methods of producing and distributing more goods and services per given amount of labor. In fact, the modern standard of living was made possible only by the continuous increase in efficiency, technically labeled output per man-hour, over the past 250 years, right? And so, one of the reasons why we're able to have such a drastic increase in the standard of living, just not even just in America, but like society in general, if you really put it in perspective from even just a couple centuries ago, it's downright amazing on how far just technology and society has progressed in general, on how the worries we can have today would not have been even thought of 200 years ago. Just you had more important things to worry about, because back then it was more of okay, how's the harvest doing, which obviously is still a problem today, but it's not as widespread of a problem as it was back then in terms of it being directly related to individuals, right? So there's much fewer farmers because the industry is much larger, and this is just keeping one example. You can basically push this or this argument for efficiency in society kind of onto essentially everything you can look around, like sitting in a parking lot in a truck, seeing vehicles, hotels, bridges, factories. It's name it. So, okay. So another way an economy grows is by adding to its capacity to produce, which is kind of a slight change on the perspective of efficiency. By becoming more efficient, you can also become, or you can also increase your capacity to produce, right? And so that it gives you the ability to do so, because you have a rate, which is kind of your efficiency, and then you have kind of the amount of effort that you would have, right? And so by becoming more efficient, you can produce more with the same amount of effort, right? Okay. So, in other words, high interest rates today imply less full employment output than otherwise tomorrow, because first, tomorrow's labor has less equipment to work with than it might have, and second, this equipment is less efficient than it might be. And so essentially his argument is by increasing interest rates, you're decreasing business or efficiency. And so you're essentially taking away tomorrow's output than what otherwise could have been, is his argument. And it's kind of similar to the whole, like, by borrowing so much, like, an argument you see more kind of, I guess, modernized, that you see more today, is where you have the whole argument that businesses borrowing so much today is basically pulling demand from the future to today, to where they're profiting now for something that would have been in the future because people aren't having to save. I guess it's more also for like consumer debt and such, to where it's consumers borrowing today to buy stuff, and so they're pulling their ability to purchase goods and services tomorrow into today by borrowing that money instead, and they're paying a premium interest on top of that. And so by increasing that rate of premium, they're not able to pull as much principal from the future to today. So there's that. Okay, so notice the payment of this low growth tax, he's talking about high interest rates, does not at all depend on the economy being plunged into a recession. Even when the economy is working at full employment levels, high interest will dull the inducement to invest, right? And so he's talking more from a business perspective, to where at higher rates of interest, businesses are going to be less likely to invest in future production, is his argument. There's certain things that you could see in certain industries to where, I mean, there's not much of a choice. Like, I think the oil industry might be a good example, is specifically with like pipelines and stuff, to where you have to, when you have industries that have massive amounts of construction that and you have construction projects that are like millions or billions of dollars, then you pretty much have to pull that out as debt, and then just basically have your business produce enough cash flow to service that debt. And so essentially it's not necessarily saying the economy has to go into a recession for it to be a problem, because by increasing interest rates, you're increasing your cost to service that debt, and therefore you're taking more out of your cash flow as a business. More from like an investment standpoint, like if you're looking at investors, they'd probably invest more. And so whether that be within, because they're getting paid more interest, and so that might be that'd be a higher incentive for investors to basically just set it and forget it. Because if you're talking about people who are extremely financially literate, they're going to basically make money no matter what the environment is. And so if you have low interest rates, they're going to figure out other ways, whether it be via like arbitrage or something else that they know how to do, borrowing themselves, whatever. And then, which is typically what you'd see with arbitrage, where you're borrowing at a lower rate than you're lending out. But yeah, that's a whole nother business model. But it just seems he's looking at it only from the business's perspective, which is fine. It's just something you want to state. And because there's also multiple sides, which is why I brought up the investor side of it. Okay, so high interest, therefore, can tax away production by two different and not necessarily connected effects. One, the cutting down of today's production. Talked a little bit about today with not being able to borrow as much to build now. And two, changing the composition and not the amount of today's output by restricting the capacity available for producing tomorrow's output, right? And so basically, by being less efficient, you can't produce more in the future. Okay, so that's part of it. And then, so it gets a little bit more into a history comment that I just kind of wanted to state, because I mean, I think history's cool and it's really helpful to put things in perspective, because this book was written in a period to where I'm less well versed. So what I mean by that is like the 50s and 60s. I mean, it's kind of, you had like post World War II and then Korean War, and so it's kind of specifically in monetary policy and kind of banking history, I guess, the history of money. It's not as, I don't want to say prominent, but like at least I have read less about it. We'll go with that. So it's pretty interesting to get kind of filling in those holes per se. So in later periods, such as the prolonged credit squeeze of 1956 to 57, it was felt that business was building capacity more rapidly than consumer demand was increasing. In recent years, the balance of payments deficit was cited. Higher interest rates were necessary to prevent American capital from going overseas, lured by a favorable return on foreign short-term investments. And throughout this 10-year period, there has been constant talk of fighting inflation by ever tighter credit conditions, right? So especially like with higher interest rates, here domestically, you'd kind of incentivized American money to stay in America rather than go overseas, which is one thing he brings up. And also just one thing I enjoy and one thing I've noticed is, like he says, the credit squeeze of 1956 to 57. And so a lot of the times when people look at, say, like the Great Depression, for example, to where there is, people tend to think that it's like, you know, a decade and a half of just continuous severe depression, everyone's hurting, the economy's trashed the whole time. When that's not really the case. There were like 2 or 3 recessions within that period, just kind of, I don't want to say like speckled throughout. I forget the exact dates on them off the top of my head, but just as an example, right? This isn't like, you know, a decade long of just depression. There was a lot of things. It's kind of like in the 40s, late 40s, so like right before this happened, when the Fed had yield curve control, and inflation was at like, I think 19% or something. So you had like, and the yield curve was pegged at 2.5% for the 10-year bond, and so you had, or 10-year treasury to be specific, and so you had like, what is that, negative 16.5, negative 17, round numbers, real yield on bonds, right? So that's financial repression by its definition. So just to give examples, and I'm trying not to go too much on a tangent. Okay, so kind of to reiterate, high interest works by cutting demand for goods and indirectly labor. Again, businesses not able to be as efficient, produce as many goods. Also, they aren't able to basically fund more labor, and so it decreases the business's demand for labor itself, right? And that's where the unemployment comes in and everything. Yeah. And also, I like to write notes in my books, and so I literally wrote next to this last one, LOL, just because it really put it in perspective of when this was written. So finally, and perhaps most important of all, the government's interest rate decisions vitally affect the future of our country in its race with the communist world. And then he starts going off about Mr. Khrushchev and the Soviet Union outproducing us, and then their economy stumbling and everything. Yeah. So this was in the 50s and 60s, I believe, for an exact date. Let's see if I can find the published real quick. But it was definitely written in the 60s, because that's essentially the end of which he cites is like 64, I believe. Yep. First published in August 1964 by the Subcommittee on Domestic Finance of the House Banking and Currency Committee. So it really puts it in perspective on why and how this was written. And so from kind of looking throughout history and remembering that time period, hopefully that kind of puts this in perspective for you guys as well. Let's see. Hopefully that helps. That's the end of this chapter. So I highly recommend getting this book, because just in general, it shows it's a different perspective, because you pretty much, at least I have only really found so far, excluding like kind of mainstream-ish perspectives on the Federal Reserve and stuff, it seems like everyone's like, how to word it? Okay. This book gives a really good alternate perspective on the Federal Reserve and the monetary system in general, right? But you need to read it from the perspective of knowing that it's very government-centric, and that's how it is. He's very pro-centralization of the monetary system, specifically only for the government, right? And so, yeah, there are some technicalities in here, specifically constitutional ones in terms of what the powers Congress is granted, that I'll have to breeze over again, or I guess revisit before I talk about them much more in depth, just for clarification, and because that's something I want to be like really sure on before I start talking about it, because that's a very important nuance that needs to be talked about. Anyways, it's a decent little book. I just found it on Amazon. A Primier On Money. They make other reports and stuff like this. So, yeah. We'll leave it at that. It's definitely a good read. He does a really good job of explaining stuff. I like how he formats it to where he'll like later in the book, it's literally like question, answer, kind of like a Q&A. For example, he'll have like, how does the Federal Reserve extinguish or reduce bank reserves through open market operations? And then he has a paragraph. And some of them he'll ask a question, and then it's like an entire like 2-3 pages. Like this one. No, there's a question there. I was trying to find a longer term one. But other questions he gives, like, can Federal Reserve officials help the U.S. Treasury and U.S. taxpayers without increasing the money supply? Stuff like that, right? And so he also does some to where he gives tables, and I think he has a balance sheet or two in here somewhere. I don't see the exact page, but anyways, we'll leave it at that. So I hope you guys have a good day, and I'll see you on the next one.